Good morning, good afternoon, everyone. Am I audible now?
Yes, sir.
Please respond, anyone. Okay. Thank you. Okay. Yesterday class we discussed about the business finance introductions, and in second unit we discussing the financial markets. Okay. Just we recall that last class, and then we enter into the further slides. Okay. Okay. 1 minute. Wait. Okay. In yesterday's class, we discussing about the financial markets, different types of financial markets. We on the different types of financial market, we classifying the financial markets and in two ways. That is, one is capital market and another one is money markets. In capital markets, we subdivided into two types. One is primary market and secondary market. Both are in capital market dealing with only equity shares and preferential shares and the debentures and others. Okay, equity shareholders are like a company owners. Okay, and preferential shareholders and debentures are the uh, we borrowed the money from outsiders. We paying a fixed rate of interest to the preferential shareholders and debenture holders, but equity shareholders get only share from the profit. If that particular financial year they got the profit profit of company, then wait. Okay, somebody in messaging me. Can you give me mobile number? Okay, I will try. In last class, I will give total PPTs and my phone number also. Don't bother about that. First, you listen the class. Okay. After completing this last class, after completing this subject, in last class, I will explain the important questions and I will give my mobile number, and also I will explain about the pattern of question paper. Okay. I will give all subject related important questions and different types of what they are asking in previous year question papers. So I will explain in last two classes. Okay, don't bother about that things. Okay, you want take the slides picture, you take it. Okay, and everyone, I think they have their own textbook. So in textbook only, I see in the textbook only I prepare the slides. Okay, you first listen the what is right here, then you understand the main some difficult terminologies are there. Just you find out the uh, in upcoming clear meaning in next two classes. Okay, thank you. Okay, so don't disturb my class. Okay. uh, yeah, okay. Financial markets can be divided into two types. One is capital markets and another one is money markets. In capital markets, subdivided into primary market and secondary market. Both are traded in stock markets. Okay, in stock market we see the some of equity shares like Reliance share and Tata shares, Adani shares, and Voda Idea shares. So every day their market value is changed. Previous value is based on previous value, present value. For example, in previous day it is traded around 12 rupees. Idea Vodafone share. Now today is making some actually because Monday to Friday is a trading day. Okay, Saturday Sunday holidays. So in before trading days, the share value may be fluctuate compared to previous year and the last month, the last year. So it is depending upon market conditions. Okay, here we see see this different types of shares. One is equity shares, another one is preferential shares, debentures, and others. Others means any bank loans, long-term bank loans. The equity shareholders are the actual owners of the particular company, and the preferential shares and debenture holders and other bank loans are the like a loans. We taking outside loan from the expansion and for modification, or some different types. We use the borrowed funds. For using that borrowed funds, we pay certain type of interest, certain rate of interest. That is, if we paid preferential shares around example, for example, 10% or 15%, and debentures around 10%. Likewise, we are paying fixed based on our profits. Without making profit, also we compulsorily pay the interest to the preferential shareholders and debentures. But equity shareholders only get the if the company get the profit on the time, only equity shareholders get the share of particular dividend. Okay, this is are all the capital markets. It is a long term in nature. Okay, money market is a, if within 1 year, within 1 month, or within 15 days, we use the our pocket having 100 rupees, 200 rupees. Likewise, our company don't have maintain use funds. So based on their requirement, it is using this treasury bills and commercial papers, call money, certificate of deposits. These are all the within 1 year time period, uh, uh, shares. Okay, this is the, are all the financial market. Second slide. Okay, here we discussing about the 1 minute. We discussing about yesterday class. Wait. We discussing about yesterday class cost of capital. Cost of capital means it is the return expected from the providers of the capital. It means capital providers are we divided in the above slide four types. One is equity shares, preferential shares, and debenture holders, and others. Others means any bank loans. So there that total fund we consolidated, and total we calculate the cost of capital. For example, if you want to start a one big company. Wait 1 minute. Okay. Okay, here in previous slide we discussing about the different types of capital markets. In capital market, in secondary market, especially secondary market, we see the primary market and secondary market. We see the equity shares, preferential shares, and some other debentures. Likewise, okay, these are all called the overall capital of that company. In capital, for example, we start one big company. It requires 100 crores. So one individual person cannot have that huge amount. So what he do is he he trying to issue the prospectus uh, about what business he started, and how much capital is required. So which the capital is which is required for fixed assets, which is required for working capital. So it is totally maintain one entire columns details on that. He issue the one prospectors. Based on that prospectors, he he applied for the IPO, initial public offer. So if permits the SEBI and stock markets, he issue the shares to the public. Likewise, if he requires 100 crores, on that 100 crores, 50 crores from the equity shareholders, 30 crores from the preferential shareholders, and 20 crores from the what you call any debentures. Okay, this is the structure of the capital of that particular company. In that structure, equity shareholders are the majority holders. Means he maintain the that whole company, and if get a company get any loss or profit, he is the responsible person. Okay, equity shareholders are the actual owners of that particular company. Okay, first in that cost of capital, we discussing about the first one is debentures. In debentures, uh, we subdivide into two types. One is redeemable debentures, and the second one is irredeemable debentures. Redeemable debentures means it is a debentures which is not redeemed by irredeemable debentures means in lifetime. In the company lifetime, debenture holders they don't get primarily initially they what he paid that amount not get back at the lifetime. At the time of liquidation only he get some portion of amount. Okay, otherwise he don't get any amount. Then in in irredeemable debentures they get more interest rate. Okay, so how we calculate that interest rate in a particular situation. So here we see the formula, that is kd is equal to I by np into 1 minus t. Here 1 minus t means 1 minus t means t is a tax rate. Okay, kd is equal to is a cost of debt after tax. It means everyone knows, I think, in financial accounting we calculate the in first one we calculate the trading and profit and loss account, and next we prepare the balance sheet. Okay, here in trading and profit and loss account, on the on the trading and profit and loss account we find out the how much profit we get in this particular financial year. That means financial year means 12 months, 12 months period, that is 2021 April 1st to 2022 March 31st. In between, how much profit they got. So that is called net profit, and we find out the net profit through the financial accounts. Uh, in that net profit we called in financial in business finance, that net profit we called as EBIT, that is earning before interest and tax. It means we didn't pay any interest to the debenture holders, and we didn't pay the tax to the government. So what we get in net profit based on trading and profit and loss account, that is not a correct profit. So uh, after paying the interest to the debenture holders, then we get the EBT, that means earning before tax. After pay the tax percentage to the government, then after we get the earning after tax. Okay, that earning after tax is that amount we will give to the equity shareholders. In before, what we get the net profit, that is called EBIT. That EBIT interest rate is calculated based on how much percentage, how much amount we give to the debenture holders. That portion we will deduct it from the EBIT. So here, cost of redeemable debentures, based on this, we calculate based on this formula, we calculate the KD value for the irredeemable debentures. Okay, then redeemable debentures. Redeemable debentures. Okay. Okay, cost of redeemable debentures. KD is equal to how we calculate the cost of redeemable debentures. How much cost we spend that debenture value. We calculate the follow based on this formula. That is 1 plus RV minus N by RV minus NP by N whole divided by RV plus NP by 2 into 1 minus tax. So RV equal, RV means redeemable value, NP means net proceeds or current market price. That is every company share is uh, trading on the stock market on particular date. For example, in 4th February, on Friday, particular Reliance share value is around 2,300, 2,200. That is the market value of particular share. That amount we showing here, that is net, the we showing here, that is market price, that is net profits. And RV means redeemable value of debentures. At the time of, if in case cost of redeemable debentures, we issue the 10% of redeemable debentures for 10 years. After each one is 100 rupees. That means we, for example, we issuing the 10,000 debentures to the public for 10% of interest rate, which year we redeemed after completing of 10 years, only we redeemed that debentures. So how much money paid, that redeemable debenture value means, if in case we redeemed, we first mentioned in the prospectus, for example, 100 share, 10,000 shares of 10 percentage redeemable debentures at a price of 100 rupees. It is redeemable. It is redeemable at the time of after 10 years. We pay 150 rupees likewise. So here how much rupees we write here means 150. Okay. And the tax is a tax rate applicable based on the income tax rates. And N is the remaining life of debentures. If in case we uh, redeem, sorry. Okay. So based on our formula, we calculate the at the time of we redeem it after 10 years, but we calculated in between 5 years or 7 years how much money actual worth of that debenture value. So based on this formula, we calculated. Okay, third one. So this is the procedure. This is the question. So based on irredeemable debentures formula, we calculate the KD value, cost of debentures value. Okay, and in previous class we discussed about this. Okay, and this is for cost of debentures for redeemable formula, and this is the problem. Based on this problem, we incorporated this all things in this formula. We get the ultimately how much the value is cost of debt is 11.67 percentage. Okay, then we coming to the second one, that is cost of preferential share cap, cost of preferential shares. Cost of preferential shares means the preferential shareholders. In previous class also I explained from, okay, this is the cost of preferential shares. KP is equal to, we in this also we subdivided into two types. One is cost of redeemable preferential shares, cost of redeemable preferential shares. Cost of preferential shareholders are the paid dividends at the specified rate on face value of preferential shares. Same likewise, debentures also, we paying the some face value, based on some face value we pay the interest to the preferential shareholders. But difference between the debentures and preferential shares is tax burden. Tax is deducted in debenture, or how much interest we paid, that is we showing in the tax system like expenses. But preferential cost, preferential interest is not showing like likewise. Okay, so cost of preferential share capital we subdivide into cost of redeemable preferential shares and cost of irredeemable preferential shares. This is the formula for cost of irredeemable. Irredeemable means in their lifetime we they didn't get how much initially they paid. So this is called irredeemable debentures. Okay, cost of renewable preferential shares formula is equal to KP is equal to PD by P0. PD is a annual preferential dividend, and annual how much dividend we pay, and net profits issue of preferential shares. So at the time of issuing, how much preferential share value that is. So see the problem. If our energy is issued preferential weight, okay, which so the all are understand Telugu?
No, sir.
No, sir.
It's better to explain to me in Telugu.
No, sir. Please explain in English.
Just you message me.
Yes.
Okay. Okay, we will see. Here in this okay, no problem. And okay, so here in previous slide we see the cost of debenture value. Then now we see the preferential cost of preferential share, how much cost we spend on that preferential shares. So see the problem. If our energies is issued preferential stock at 100 rupees per share with a started dividend of 12 rupees and flotation cost of 3%, then calculate the cost of preferential share at the time of how much uh, price is price to the particular preferential share. Our preferential share is 100 rupees. How much cost we incurred, like company incurred 3% of expenses for issuing that preferential shares. So how much money we get, and like company get means if our energy they spend 100 rupees per share, but company get only 97 rupees, because difference between that 3% is a floating cost. Floating cost means it is a expenses for issuing preferential shares. Okay, after deducting that floating cost, then we get the net profits, that is called uh, net profits from the PO. Okay, we incorporated this formula above problem. So we get the 12.37%. Okay, then you don't bother about the slides. No, were coming after coming 2030, after 2021 23 slides, you will clear about this all things. Just you listen what I am saying. If you want take any pictures, you take. Okay, then second formula is cost of redeemable preferential shares. Okay, cost of redeemable preferential shares. Same likewise in debentures, we use the formula. So like we in preferential shares also same likewise we similar type of formula here. Redeemable preferential shares, that is equal to KP equal to PD plus RV minus NP by N whole divided by RV plus NP by 2. This is the formula for cost of redeemable preferential shares. Okay, based on this formula, we calculate the KP. How we calculated is, see the one example problem, that is XYZ Limited issue the 2000 shares for 10 percentage of preferential shares of 100 rupees each at 95 percentage each. The company proposed to redeem the preferential shares at the end of 10th year from the date of issue. Calculate the cost of preferential shares. Okay, here what he is saying is Actually XY Limited issuing 2000 shares at what price? That is 100 rupees for each share. Okay, how much interest they paid for each share is, that is 10%. That means 100 rupees per share. How much interest they pay? 10% means 10 rupees. Okay, 10 rupees is a interest, and at the time of redemption, uh, how much we pay? We taking the 100 rupees from the particular preferential shareholders, but we paying the 95 rupees only at the time of redemption. Okay, we we incorporated that above solution, above problem into solution. See the, okay. Okay, here 10 is 10 10 is the interest value, plus 100 rupees is the redeemable value, 95 is the net profits. How many years we issued? 10 years. We calculate the here how much we get. 100 plus 95 by 2, that is same 99, around, wait 1 minute. That is 97.5% here. In the above, based on this calculation, just use the calculator and calculate the, we get the 10.77% for KP. Okay, this is the cost of redeemable preferential shares. Next slide, we come to the actual owners of that particular company. Okay, cost of equity share capital, that is KE. KE means it is just like any other source of finance. In previous we discussing about the one particular company. For example, XY Limited, they want to establish one company, but they require huge amount, bulk amount. How he do means, he issue the shares to the public, different types of shares, that is preferential shares or equity shares or debentures, but we use that certain portion of percentage, that we get the actual owner will get the more return based on some structure, cost of capital structure. Next unit, we discussing about the cost of capital. On the time we understand the what is this exact meaning of equity shares and preferential shares and debentures. Okay, here cost of equity share capital is just like any other source of finance. Okay, cost of equity is a expectation of equity shareholders. Okay, here expectation means actual owners of that particular company, what they expect for investing the amount in that particular company, what they expect. Generally they expect more returns, that is more profits. If that particular company get more profits, then it will be that particular company share value also and market value also increased, and also more shareholders interested to purchase that particular company shares. So here, how that particular KE value we will calculate it based on that some procedure is there. Okay, we know that the value of the performance divided by expectations. If we know the value of the performance, then we can calculate the expectation as balancing figure. Here what he say means, what is expected equity shareholders, but based on particular company. For example, X is a person, he invested 10 lakhs to the particular XY Limited company. Then what he expect from more returns, so more returns and more profits from particular that. uh, how we expect that return means, based on this cost of equity share capital, we find out. Here performance means the amount paid by the company to investors, like interest, dividend, redemption price. In case of debentures and preferential shares, amount of interest or dividend is fixed, but in case of equity shareholders, it is uncertain. Why? Because actual owners of that particular company is the equity shareholders. But if they, that particular company get the profit only, they get the share of that particular profit, dividend. Otherwise they don't get. Okay, but preferential shareholders and debenture holders, they will get the fixed rate of interest. Okay, here he is saying like this. And thereafter, no, I'm not very comfortable with Hindi. I know very well in Telugu. If you want explain in if you want to require to explain in Telugu, I will explain last 10 minutes. Okay, it is simple, and up to 50 minutes I will explain in English. Last 10 to 15 minutes I will explain in Telugu. Okay, if you understand Telugu, you will understand. Otherwise I can't speak in Hindi. Okay, sorry. Next, okay, here if you comfortable with Telugu, then I will explain in Telugu. Okay, okay, I will try. Okay, here performance means the amount paid by the company to investors. Like earlier also we discussing some like this. Okay, in the case of debentures and preferential shareholders, amounts interest okay. Therefore, there is not a single method to calculate the cost of equity, but different methods which depending on various factors like. Okay, here in previous cost of debentures, cost of preferential shareholders, which okay, in last 10 minutes I will explain in Telugu. Up to 50 minutes I will explain in English. Okay, don't bother about that language problem. Okay, here okay, sorry. Therefore there is not a single method to calculate the cost of equity, but different methods which depending on various factors like. అంటే ఏంటంటే it means for calculation of equity share capital, cost of equity share capital, we use different types of methods for calculating that cost of equity share capital. That is, first one is, if dividend is expected to be constant, then dividend price approach should be used. If particular every year, wait, if the dividend is shareholders is expecting constant and fixed rate of interest every year, that that situation we use the dividend price approach. Okay, for example, here 10,000 equity shares are there. Each share value is 1,000 rupees. Okay, how much money there? 10,000 into 1,000 is, means 1 crore. 1 crore of equity share capital. Okay, the equity shareholders every year get the around 10% of dividend. Every year they expecting, equity shareholders are expecting every year constantly. Every year means 10% means 1,000 rupees into 10%, that means 100 rupees. Every year each shareholders, they expecting the constant, like previous year 100 rupees, now 2022 also 100 rupees, 2023 also now 100 rupees, 2020 also 100 rupees. Likewise, they expecting uh, fixed rate nature. Then we use the method of dividend price approach. Then second method is, if earning per share is expected to be constant, then earning price approach should be used. And third one is, If the dividend and earnings are expected to grow at a constant rate, then growth approach used. If dividend rate is expected every year constant, then the time we use the dividend price approach, every year they expecting some more. For example, earlier example, how much they get the dividend, that is 100 rupees. Okay, but they expecting every year growth, that is in 100 rupees also he want to get the 2% or 3% extra. That time, which method we used means growth approach used. It is proposed by Garden. This is also called as a Garden model. And if it is difficult to forecast the future, then realized yield approach should be used, which looks into past. Here in fourth method, everyone don't know how much percentage, how much profits, how much money we will get in future. For example, our company financial year start with 2021 April 1st to end with March 31st, 2022. So in between 1 year, how much profit we get, how do we know? So likewise, above three methods are not relevant for calculation of cost of equity. So fourth one is, it is very relevant for calculating and expecting the how much dividend we expecting near future. So this method is very important. The fifth one is, all the above methods calculate the cost of equity as a balancing figure. Okay, above four methods calculating the cost of equity balancing figures when the cost of equity expectation of investors is depending on risk. Okay, this is the very important model, CAPM model, that is cost capital asset pricing model. Here, how much risk how much risk we taken, same percentage we return also likewise. For example, uh, I'm my name is Arun, so I'm not a risk taker. Okay, in my pocket I have 10,000 rupees. In that 10,000 rupees, simply I go bank and deposited in savings account. How much return I get? That is 6% to, I think 6% to near to 10%. That means if I invested 1 year in bank savings account or fixed deposits, how much money we get? Around 8% if bank is given to me. That means 800 rupees only I got for deposited in that 10,000 rupees in the bank. For example, it, it is a very less risk. It is a very less risk. Okay, somebody likewise my brother not thinking like me, and he have 10,000 rupees. Then he immediately go and put it in cricket betting. So in that cricket betting, if he put 10,000 rupees in particular team, if that team is win, how much he get? Double the amount. If he get double the amount, immediately if that particular match win that in that match win that uh, match, then we will get immediately 20,000 rupees. So here, if in case that match is lost, how much money he lost? That is entire 10,000 rupees my brother is losing. But here risk is high and the return is also high. That means 10,000 he is putting within 1 day, it is double the amount. But I am not a risk taker. So I simply I simply will go and deposited that 10,000 into fixed deposit, and I will get at the time of ending of the 1 year, I will get only 10,800 rupees. So how much risk you taken, likewise also you getting the return. So here that is explained in the CAPM model. So this five method explaining the next slides. Okay, see the here. Okay, cost of equity share capital. In previous slide we explain each one, that is the dividend price share, dividend price approach, earning price approach, growth approach, realized yield approach, cost asset pricing model. These methods are all are calculating the cost of share capital. Okay, if in case we use the first method, okay, that is dividend price approach. For dividend price approach, what is the formula? That is cost of equity, that is kg is equal to d by p0. Kg means cost of equity, d means expected dividend, also with the expected dividend after completing the 1 year. Next, market price of equity, expected dividend. Okay, here this is the formula for calculating the first approach, that is dividend price approach. Okay, this formula is clear. Next, second one is okay. Here, for example, the cost of equity, we calculate the cost of equity. For example, one person expecting the dividend, that is 10 rupees. Market price of that particular share value is 100 rupees. What is the KE is 10 divided by 100. That is that KE how much? That is 0.1. In percentage, 10 percentage. In that based on that particular approach, how much return you get? That is 10 percentage. Okay. Second one is earning price approach. This is the second method, like previous method and this method are likewise same. That is cost of equity is equal to E by P. That is E means current earnings per share and market price of share. So here you see expected dividend. Yeah, but here the actual rate we taken, but here it is they are expecting. This is the second method, second approach, and third one is growth approach. Okay, in first method we use the same formula, that is d1 by p0, but extra we add only g, that means growth. How much growth he expected particular equity shareholder, that is d1 equal to the within next year how much they expected shareholder, that is he expecting 20% or 30%. So how much he expecting plus growth rate, how with expecting 30% with how much growth at the previous comparison to previous year, how much growth rate is occurring. So we adding here. So then after that we divide that current market price. See the one example. Okay, a company has paid dividend of 1 per share. Okay, the face value of particular share is 10 rupees last year, and he is expected to grow 10% every year. Calculate the cost of equity if the market price of share is 50%, 55 rupees. Okay, here at the time of issuing your share value how much, that is 10 rupees, but now that particular share value how much he increased, that is 45 rupees it is increased. So now market value of that particular share is 55 rupees. Okay, wait, completing this I will explain. Okay, here cost of equity d1 by p0, that means d1 it is net expected dividend, p0 is equal to current market price of particular share, g is the constant growth rate every year, how much rate they expecting, how much growth rate is expecting. So here see the problem, a company has paid dividend of 1 rupee per share, that is that to face value he given face value 10 rupees, and last year it is expected to grow 10% every year. Okay, in last year they are expecting next year also it is 10%. Okay, calculate the cost of equity if the market price is 55 rupees. Market price is at 55 rupees market price, they're getting 1 rupee of dividend. Okay, how much return e getting in percentage? We calculating based on 10% growth rate. Just we simply just we incorporate it here, then we will get the actual KE. That means cost of equity value we will getting. Okay. Okay, this is the CAPM model, capital asset pricing model. It is. This is the actual for understanding purpose. We prepare one chart here. In x-axis, we taken the risk. In y-axis, we taken the required rate of return. That is, in x-axis, risk means beta. In technical term, risk we calculated based on standard deviation. That is beta. Beta we will calculated. Beta is a risk. How much return he expected right here. Okay, RF is a fixed rate of. In earlier side we explained have a 10,000 rupees. Based on the 10,000 rupees I deposited in bank, how much I get the return, that is 8%. That is the risk-free rate of return. That is, and how much it is 8%. That we call it the risk-free return. It is parallel to x-axis. Okay, horizontal to x-axis. It is nothing will change. If you invest in 10,000 rupees, 20,000 rupees, 50,000 rupees, or 10 lakhs rupees, but you get fixed rate of return, that is 8% only. Okay, that is the risk-free rate of return, that is RF. Next one is beta. Beta, you know, beta means it is a risk. Okay, here we calculate the risk premium. Okay, this is the cost of equity formula, that is RF plus beta into RM minus RF. That is RF is a risk-free. Risk-free means bank rate. Okay, then beta is a risk. How much risk we taken? Okay, RM means return, market return. Okay, minus RF. RF means risk-free rate. Okay, based on this formula, we calculate the CAPM model. Okay, wait. Okay, here, so RM is the rate of return on market portfolio. Okay, then RM minus RF is equal to market risk premium. Everything they explain, they mention in the problem, just we identify the which one is beta, which one is RM, which one is RF. We identify, then we incorporate that formula, then we will get the cost of equity under the CAPM model. Okay, you see the one problem. This is a very simple problem. See, calculate the cost of equity capital of H Limited, whose risk-free rate of return equals to 10%. Then the firm's beta equals to 1.75, and the return on market portfolio equals to the 15%. Everything is given. Just we incorporate this numbers into this formula, then we will get the KE. That is, RF is how much our risk-free rate of return is 10%. That is 10% means if we invested in 100 rupees, how much we will get? 10 rupees. That is the like 0.1% plus beta value is 1.75. Then RM, if we mention in the percentage, we write the points wise. Okay, that is 0.15 percentage minus last one is RF. RF means risk-free rate of return. Then we will calculate. Then we will get the exact current market uh, cost of equity. Okay, that is 18.75 percentage. Okay, end of this I concluded. Okay, thank you. If you want in Telugu, just I will explain in 5 minutes. Okay, టుడే ఓకే ఈరోజు జస్ట్ ఏం చెప్పలేదు మనం అసలు ఫైనాన్షియల్ మార్కెట్స్ అంటే ఏంటిది, క్యాపిటల్ మార్కెట్స్ అంటే ఏంటిది, దాని తర్వాత ఈ క్యాపిటల్ మార్కెట్స్ అన్ని కూడా ఫిక్స్డ్ నేచర్ అంటే ఒక స్థిర అంటే ఫిక్స్డ్ నేచర్గా ఉంటాయి, అంటే ఒక లాంగ్ టర్మ్ నేచర్లో ఉంటాయి. ఎట్లా ఒక 5 years కానీ 10 years కానీ 20 years కానీ అట్లా ఉంటుంది అనమాట. I will give after completing 2 or 3 classes my mobile number. So I have some other classes. So please understand. Then I will give next week or other next week I will give definitely. Don't worry. Okay. Then okay. Just 5 minutes. Financial markets. ఓకే, ఇన్ ఫైనాన్షియల్ మార్కెట్స్లో ఏంటంటే మనకు ప్రైమరీ మార్కెట్ సెకండరీ మార్కెట్ అనేటువంటి ఉంటుంది. ప్రైమరీ మార్కెట్ అంటే ఏంటంటే ఫస్ట్ ఇనిషియల్గా మనం ఇష్యూ చేస్తున్నప్పుడు దానికి ఎట్లా ఉంటుంది అంటే ఇనిషియల్ ఇష్యూ చేసినప్పుడు ఏ విధంగా, తర్వాత దాన్ని స్టాక్ మార్కెట్లో సెకండరీ మార్కెట్లో ఉన్నటువంటి షేర్స్ అన్నీ కూడా స్టాక్ మార్కెట్లో లిస్ట్ అవుతాయి అన్నమాట, స్టాక్ మార్కెట్లో ట్రేడ్ అవుతూ ఉంటాయి. మీకు తెలుసు అనుకుంటా బిఎస్సి తర్వాత ఎన్ఎస్సి. సో అప్పుడు ఈ సెకండరీ మార్కెట్లో ఉన్నటువంటి షేర్స్ మాత్రమే లిస్ట్ అవడం అనేది జరుగుతుంది. మనీ మార్కెట్ అంటే సంవత్సరం లోపల టెంపరీగా అప్పటికప్పటికి కావాల్సిన ఏమైనా కంపెనీకి ఏమన్నా మనీ అవసరం ఉన్నదనుకోండి, ఈ మనీ మార్కెట్ని యూజ్ చేసి అంటే బ్యాంకుల నుంచి టెంపరీగా వితిన్ 10 daysలో 5 daysలో వితిన్ 2-3 daysలో లోన్ తీసుకోవడానికి అవకాశం ఉంటుంది అన్నమాట. కాకపోతే దానికి కట్టేటువంటి ఇంట్రెస్ట్ రేట్ ఎక్కువ ఉంటుంది, దానితో పాటు అమౌంట్ కూడా తొందరగా ఇవ్వడం అనేటువంటిది జరుగుతుంది అనమాట. ఇంతకుముందు మనం ఏం తెలుసుకున్నాము, ఇవన్నీ కూడా కాస్ట్ ఆఫ్ క్యాపిటల్ మొత్తం 3 రకాలుగా డివైడ్ చేసిన, ఒకటి కాస్ట్ ఆఫ్ డెట్, కాస్ట్ ఆఫ్ ఈక్విటీ, కాస్ట్ ఆఫ్ డిబెంచర్స్ అని చెప్పేసి. సో ఒక్కొక్క దానికి ఎంత కాస్ట్ అవుతుంది ఎట్లా తెలుసుకుంటాము అనేటువంటి దాన్ని మనం ఫార్ములాను యూజ్ చేసి ఒక్కొక్కటి అంటే డిబెంచర్స్ అంటే ఏంటిది, ప్రిఫరెన్షియల్ షేర్స్ అంటే ఏంటిది, ఈక్విటీ షేర్స్ అంటే ఏంటిది, ఒక్కొక్క దాని గురించి ఇంత ముందుకు ఎక్స్ప్లెయిన్ చేసినాం అనమాట. కొద్దిగా అర్థం నెక్స్ట్ అంటే ఒక 2-3 క్లాసులు కంప్లీట్ అయిన తర్వాత అంటే అప్పుడు మీకు కొద్దిగా క్లారిటీ వస్తుంది. ఇది కొద్దిగా అంటే కొత్తగా యూజ్ చేసేటువంటి టర్మినాలజీ కాబట్టి మీకు అంత అర్థం కాకపోయి ఉండొచ్చు. చూద్దాం నెక్స్ట్ క్లాస్లో అర్థమవుతుంది, చూద్దాం. ఓకేనా? థ్యాంక్ యూ ఎవ్రీవన్.